Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hemoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're delving into a recent development involving the Bank of Montreal, or BMO, which has decided to reinstate the Office of the Superintendent of Financial Institutions stress test for uninsured mortgage switches. This move comes after BMO initially adopted OSFI's decision to remove the stress test requirement last month. However, BMO has now reversed course, meaning that borrowers with uninsured mortgages looking to switch to BMO must once again qualify using the higher of the benchmark rate, which is 5.25%, or their contracted rate plus 2%. For those who might be wondering, a straight switch refers to the process of transferring a mortgage from one lender to another without increasing the loan amount. Meanwhile, an uninsured mortgage is a home loan that doesn't include mortgage default insurance, typically applying to loans with a down payment of 20% or more. BMO communicated this change to its broker partners on Monday, stating that the files will continue to be reviewed using OSFI's stress test. Although this stress test is no longer mandatory, BMO plans to maintain it while exploring alternative approaches for uninsured switches at renewal. According to a document obtained by Canadian Mortgage Trends, BMO asserts that its underwriting practices remain competitive and consistent with regulatory guidelines. It's important to note that even though OSFI announced the removal of the mandatory stress test for straight switches of uninsured mortgages on November 21st, lenders are still expected to conduct thorough due diligence on incoming files. Former OSFI Assistant Superintendent Tolga Yalkin emphasized that lenders must apply some form of stress test to calculate debt serviceability measures, such as gross debt service, GDS, and total debt service, TDS, ratios. This means that while the specific stress test might vary, lenders need to ensure they maintain sound mortgage underwriting practices. This has led to a divergence in how different banks are handling the qualification standards for uninsured straight switches. For instance, some banks may apply a stress test similar to OSFI's previous guidelines, while others might opt for more flexible or customized calculations based on their risk tolerance and underwriting policies. To provide a broader perspective, we reached out to several major banks. The Royal Bank of Canada, or RBC, is using the contract rate to qualify clients following the November 21st change, while maintaining prudent underwriting standards. The Toronto Dominion Bank, or TD, although no longer requiring the OSFI prescribed minimum qualifying rate for uninsured mortgage borrowers switching at renewal, ensures that debt servicing ratios are calculated with a forward-looking approach. Scotiabank is aligning its straight switches for uninsured mortgages with OSFI's recent guidance on the qualifying rate, working on the details of its program to communicate with distribution channels soon. Meanwhile, National Bank has stopped applying the minimum qualifying rate calculation for customers switching their mortgages at renewal from federally regulated financial institutions, adhering to OSFI's latest update. We also reached out to the Canadian Imperial Bank of Commerce, or CIBC, but they didn't provide a response by press time. As more banks continue to adapt to these changes, borrowers might face varying requirements depending on their chosen lender, highlighting the importance of staying informed and consulting with knowledgeable mortgage professionals. Today, we're exploring the complex landscape of Canadian homebuyer sentiment in light of recent mortgage rate changes and evolving housing regulations. A recent survey conducted by the Bank of Montreal, or BMO, highlights the mixed feelings among prospective homebuyers. According to the survey, 36% of respondents feel that falling mortgage rates make purchasing a home more feasible within the next 2 years. However, 39% remain apprehensive, fearing that future rate changes could derail their home buying plans. BMO's senior economist, Robert Kavchich, provided some context to these findings, noting that the Canadian housing market is currently in a transitional phase. He observed that market activity has picked up thanks to the Bank of Canada's rate cuts and an increase in available inventory. Kavcic mentioned that sales volumes have rebounded from last year's slump and prices are beginning to stabilize. Despite this positive shift, he pointed out that while most buyers' markets are disappearing, there are still areas of weakness. Overall, Kavcic anticipates steady sales and price activity through 2025. The survey also sheds light on how new relaxed mortgage rules are influencing homebuyer expectations. Over a third, specifically 36%, of first-time buyers believe that changes such as extended amortization periods of up to 30 years and an increased insured mortgage cap to $1.5 million will ease the purchasing process. Additionally, the survey reveals that 56% of prospective first-time homebuyers plan to utilize the First Home Savings Account, or FHSA, to support their home ownership goals, an increase from 52% last year. Awareness of the FHSA is on the rise, with 40% of Canadians reporting familiarity with its features, up from 31% in 2023. Among younger demographics, Gen Z leads the charge, with nearly half, or 48%, indicating they understand the FHSA. Nicole Au, Vice President and Head of Retail Investments at BMO, described the FHSA as like a registered retirement savings plan and tax-free savings account rolled into one for first-time home buyers. She emphasized the benefits of the FHSA, including the ability to make tax-deductible contributions, enjoy tax-free growth, and hold various investment types. Au also highlighted that purchasing a first home often involves a multi-year plan, incorporating several savings vehicles like the FHSA and Registered Retirement Savings Plan withdrawals through the Homebuyer's Plan. This strategy may also involve financial contributions from multiple generations, such as parents and grandparents. The FHSA is gaining traction as a tool for intergenerational financial support, with nearly a quarter, or 23% of parents, intending to use the account to help their adult children with home purchases. Among younger parents, particularly millennials, 42% indicated they would use the FHSA for this purpose, compared to 21% of Gen Z parents and just 7% of boomer parents. In our final segment today, we're turning our attention to a significant regulatory development in Ontario's mortgage industry. The Financial Services Regulatory Authority, or FSRA, has made a decisive move by refusing to renew the mortgage broker license of Michael Ryland Slattery and revoking the mortgage brokerage license of Skylark Holdings Limited. This decision came after a thorough review of Slattery's past conduct and his provision of false or misleading information in 3 separate license renewal applications, which is in violation of Sections 45.1 and 45.2 of the Act. Michael Ryland Slattery, who served as the principal broker for Skylark Holdings, was found unsuitable to continue holding a license due to these infractions. The FSRA's order indicates that there are reasonable grounds to believe that Skylark's business operations would not adhere to the legal standards of integrity and honesty required in the industry. This situation underscores the importance of maintaining transparent and ethical practices in the mortgage brokerage sector. The FSRA's decision was influenced by Slattery and Skylark Holdings' withdrawal of their request for hearing before the Financial Services Tribunal, effectively leaving the FSRA's findings uncontested. This action suggests a significant level of admission regarding the allegations, reinforcing the FSRA's commitment to upholding consumer protection through diligent monitoring and enforcement activities. For those interested in learning more about how FSRA is working to safeguard consumers, their enforcement database offers a comprehensive look at ongoing efforts to ensure compliance within the financial services industry. The FSRA's proactive stance serves as a reminder to all licensed professionals of the critical importance of honesty and transparency in their business dealings. As we wrap up today's episode, it's clear that the mortgage landscape is continuously evolving, with regulatory bodies like FSRA playing a pivotal role in maintaining industry standards. Keeping informed about such changes is crucial for all stakeholders, from mortgage brokers to prospective homebuyers, to navigate the market effectively and responsibly.